Okay, if we could have everybody's attention. Shh. Shh. Okay. And would somebody let the folks know in the side room if they're done eating to come on in here? That would be great. Lester, how you doing? I'm Mike Galiazzo, the president of Regional Manufacturing Institute, and I want to welcome all of you. You helped dispel the myth, by the way. Lots of times when we're planning events here, and PSA is a key partner of RMI, and I'm going to talk about that a little more briefly in a second. But there's always this thought about, well, will people come out to Hunt Valley in the morning? Well, you just proved yes. Because I got to tell you, this is like a reunion for me. This is RMI's 30th anniversary. 30 years we've been out there, you know, hey, what about manufacturing? What about manufacturing? And what's in this room are some folks that I remember for the first time connecting with almost 30 years ago. We have people coming in from Frederick. We have people from Carroll County. We have people from Prince George's County, and, of course, in the Baltimore metropolitan area. So I think it's a kind of a testimonial to the support that Maryland manufacturing has, and it's just wonderful. So I'm going to ask you to give yourselves an applause for coming out tonight, supporting that. This is PSA Insurance. We have a special relationship with them in a variety of ways, and one of which is there's Emily Moles. Emily, where are you, please? I want to acknowledge you. In the back, Emily is assigned to work with RMI and to help put events together like this. And this year, she had some help from Stacy Smith, who is our new coordinator for events and outreach for RMI. Stacy, you all know Stacy from former head of CAMI. And I want to just acknowledge Chip Lewis, who is the chairman for PSA. Chip, are you still in the room? It's that dapper young man over there. Thank you so much for your commitment to manufacturing in our industry. Also would like to thank Todd Sabins here representing Maryland Commerce. I want to thank Todd and Department of Commerce for their support. I want to thank Mike Kelleher. I know Mike's in the room, a very close partner to RMI, MEP. There he's right there. Mike, thank you for supporting this event and other activities of RMI. Also, there's a group called Minority Business Development Agency Advanced Manufacturing Center. It's in Baltimore City. RMI is a partner with them. It's our commitment to try to help create more opportunities for minorities to get engaged in manufacturing and own manufacturing. I know Scott isn't here. I see Tony probably representing MBDA. Thank you for being here. I appreciate it. And then finally, Baltimore County government. I'm not sure. I think I saw Sarah earlier. They are a sponsor of RMI throughout the year, and so again, I want to thank you, Sarah, for that. So we're going to move quickly because the show is sitting out there, not standing up here. But I do want to acknowledge first one last person. Our board chairman, Eris Melissa Rodders, is right here in the front row. Eris is okay. Anybody in this room, is there someone in this room who has never heard Anirban Basu do a presentation? Okay, that tells you, think about it, that tells you how important his word is. And I got to tell you, I know as a friend, I know that Anirban is a strong supporter of manufacturing. So all of us who have heard him before, we just can't get enough of you, man, my friend. So at this time, please welcome Anirban Basu, who's going to tell us about the future of Maryland manufacturing.
Right. Good morning, and thank you for being here. And my job is to talk about manufacturing, of course, but I'm going to do that in the context of an economic update. We're in January of 2020. The decade has just begun. I've entitled the presentation Return of the Economist. It's a Lord of the Rings theme. Why Return of the Economist? Because we did not have a recession the previous decade. And you don't need economists, maybe ever, but certainly not when the economy is good. I presume there'll be a recession at some point this decade. It'll take a long time to prove me wrong. And so I want to just give you that sense of where we are in the economic cycle, so on and so forth, but I want to do it with a very significant focus on manufacturing. There are a lot of ways to start a meeting, of course. There's the Pledge of Allegiance. There's the National Anthem. Some people like to start it with a prayer. I very much like the ring verse. 3 rings for the elven kings under the sky, 7 for the dwarf lords in their halls of stone, 9 for mortal men doomed to die, 1 for the dark lord on his dark throne in the land of Mordor where the shadows lie, 1 ring to rule them all, 1 ring to find them, 1 ring to bring them all, and in the darkness bind them. Yes, I am a geek, and I went into economics. So the way I've organized this presentation is that 9 rings for men, 7 for the dwarf lords, 3 for the elves, and 1 for the dark lord. So I've organized it as 9, 7, 3, 1. So first, I'll begin with 9 reasons for hope in the kingdom of men and women, 9 things that are really working for this economy. I mean, I think you would agree the economy is in pretty good shape, at least based on the sort of standard macroeconomic measures, whether in the form of the stock market. Dow Jones this morning neatly above 29,300, S&P creeped above 3,300 yesterday, NASDAQ meaningfully above 9,300 this morning, whether it's in terms of jobs. And that's where a lot of the strength, of course, in the economy has been observed. It's been in the U.S. labor market. We just got the December jobs report a week ago, and the nation added jobs for 110th or 111th consecutive month. During that streak, that unprecedented, unrivaled winning streak in American history, America's added about 22 million net new jobs, driving the nation's unemployment rate to 3.5%. And just to put that into context, you'd have to go back to December of 1969 to find an unemployment rate as low as it is right now in America. That's how tight this labor market is. And just to give you a sense of how long ago that was, the Orioles were good back then. So that's a very long time ago. Yes, it is true that job growth has softened a bit recently, that if you look at average monthly job growth, it's not quite what it had been, let's say, in 2017 or 2018. But that had been predicted, because with each and every passing month, it's more and more difficult to fill available job openings. We have 7.3 million available jobs in this country. Talk about manufacturing in a moment, but about 400,000 of them relate to manufacturing, jobs that continue to go begging each and every day. Many of you will tell me you can't find welders, you can't find machinists, you can't find other technical professionals. We'll talk about that, and you're not alone. It's true in construction and many other categories in which skilled tradespeople are utilized. But even with that, America added 2.1 million net new jobs or non-farm jobs over the past 12 months. Trying to give you a sense of where those jobs were created. So these horizontal bars represent net job creation for each of these major industry segments for the 12-month period spanning from December 2018 to December 2019. So what I'm trying to say is that the category called Education Health Services by itself added 647,000 net new jobs over the past 12 months. If we do the simple math, that translates to more than 50,000 jobs added per month by that one sector alone, a titanic total. But you'll notice the sector in which we have most interest today, manufacturing, also adding jobs. In Maryland, manufacturing also adding jobs. And that's not something we should take for granted. Now, Maryland, our state, has added 27,600 jobs over the past 12 months, which we have data. This is for the 12-month period ended November of 2019. Pretty strong performance. And we have been actually, among the U.S. states, one of the finest performers in terms of monthly job creation for the last 3 or 4 months. And manufacturing, I say, is part of that story. This is Maryland manufacturing employment net growth 2019 by year. You can see that it's quite common for Maryland in a single year to lose thousands of manufacturing jobs. So it might not sound like much to add 200 jobs, but it's certainly a lot better than what we've been doing since the year 2000. Manufacturing has started to come back as a source of new employment in Maryland. In fact, we've added jobs in manufacturing in our state for the last 3 years and 4 to the last 5. This is Maryland gross domestic product in manufacturing. This is the manufacturing sector's output. Again, this is, as it turns out, from the first quarter of 2005 to the second quarter of 2019. We will talk about the manufacturing recession in a moment. You can see evidence of that here. Manufacturing output, at least from a Maryland perspective, not rising very recently, but having risen significantly since the downturn. And you say, well, Anirban, I look at this output growth, but I don't see as many jobs being created. That's because the workers we're adding are highly productive. And I'll talk about that in the context of overall productivity growth much later in this presentation. This is percentage employment growth for the 25 largest metropolitan areas in the country, just to give you a national perspective on such things. So if you ask me, Anirban, where is the fastest job growth taking place in America? The West and the South? And look at that first column where the fastest job adders are. Dallas is a southern market. San Antonio is a southern market. Texas loves Texas. And business loves Texas. Very easy to do business in Texas. In fact, the folks in Texas just passed an ordinance indicating that if a local community, a municipality, takes more than 30 days to determine if your permit application should move forward, if they take more than 30 days, it's approved. They only have 30 days. In Maryland, of course, it could take 30 years. They just wait for the developer to die. Seattle in the west, Orlando, Houston, Phoenix, Charlotte, southern markets, Denver, San Francisco west, San Diego southwest, Atlanta, Tampa, Riverside, all southeast or southwest. Now, the northeast and the upper Midwest are on the right-hand column, but leading the way in our part of the country is Washington and Baltimore, as it turns out. And one of the reasons for this is obvious. Our primary industry is government, federal government in particular, and the federal government is spending like mad. And we'll talk about some of the implications of that in a moment, including defense contracting, for instance. Of course, manufacturers are heavily influenced by that. Number one company in terms of federal government procurement is Lockheed Martin, which happens to be headquartered in the state. And one of the other leaders is Northrop Grumman, which has a major presence here as well. But for the most part, the point of this slide is that job growth has been apparent through much of the country, in much of the country, and for many, many years. And so unemployment has fallen over time. I'm showing you unemployment back to 2000. The three unemployment rates. In blue, male unemployment. In green, female unemployment. In red, total unemployment. You'll notice that during the downturn, male unemployment climbs a lot faster than female unemployment. Why is that? Largely because of the industries in which men are concentrated, construction and manufacturing. About 87% of all construction workers in our country are men, 70% of all manufacturing workers in our country are men. And when those industries disproportionately took it on the chin during the downturn, each losing about 2 million jobs, male unemployment rate surges. Now, you might point out, of course, that since that time, the unemployment rates have converged between the two major genders. And so we are around 3.5%. But there is still an impact from that period during which unemployment among men was high, because many men decided, you know, enough is enough. I don't want to be in a cyclical industry anymore. I don't want to go through these periods or bouts of unemployment, so on and so forth. And so many people left the industry and didn't come back. And you see that in construction as well. You'll speak to a lot of folks who work at Home Depot or Lowe's who are former construction workers, and they could actually make more in construction, but they will tell you, I just don't like it because, you know, every once in a while I lose my job and it's just too painful. I'd just rather be here. It's very steady. And so this is one of the reasons, of course, one of the many reasons that manufacturers are having so much difficulty finding workers. This is Maryland unemployment rates by county. I mean, look at some of these unemployment rates. Howard County, 2.4%. Carroll County, 2.5%. One of the reasons our unemployment is so low in those counties is that no one is ever allowed to move there. It's interesting. You talk to these policymakers in Ellicott City or wherever, and they say, oh, we are so concerned about housing affordability. It's such a big issue. No one can ever build anything ever in this community again, but we are really concerned about housing affordability. And so when you've got those kinds of exclusive housing policies, you truncate supply, and of course, price is going to tend to rise. There is a community where unemployment is quite high. It's Worcester County. These are November rates of unemployment. And so Worcester County, home to Ocean City, has a lot of seasonal unemployment. That unemployment rate will fall as we head toward May, June, July. I can assure you. It does every year. But there's a lot of seasonal unemployment there. What Worcester County could really use is a 12-month economy. And, you know, in this search for workers, it might make sense to look at some of these dynamics. Say, where are there communities where we could use a 12-month economy? Where there are, you know, people who are looking for work. To be unemployed, you have to be actively looking for work. These people are looking for work. They can't find it. Are there chances for partnerships with Warwick Community College or whomever to say, let's create that manufacturing workforce of the future and create a 12-month economy in Worcester County, Maryland, as an example, because unemployment is so low almost every place else. So when you survey manufacturers, this is from the National Association of Manufacturers, their Outlook survey, percentage of respondents citing as a primary challenge, attracting and retaining a quality workforce, well, that's by far the number one issue. No surprise. When you got a 50-year low in unemployment, 7.3 million job openings against 5.8 million unemployed people. So how many job openings do we have for each unemployed person in America? 1.3. We could solve completely unemployment. Now, we never get to 0% unemployment. Why? Because humans are involved, right? Because, you know, Chuck says to Jerry, Jerry, I need you to do this. And Jerry says, I'm not doing that. Chuck says, you're fired. And now we have unemployment. And there's always going to be those situations. And we have a lot of Chucks and Jerrys in this economy, as it turns out. And so a lot of that goes on. There's some other issues that face manufacturing that are predictable. Trade uncertainties, rising healthcare and insurance costs, weaker domestic economy and sales for our products. We'll talk about that in a moment, but that relates to this manufacturing recession that we've been in recently. More data on that in a moment. But again, the number one issue here is finding workers. And here's a place where the public sector and private sector can really come together. You know, it's often said, you economists, you talk about all this job growth, all this job creation, but these are not good jobs. They don't pay very much. And to a large extent, that's true. A lot of the jobs are in retail trade or leisure and hospitality, which includes workers at restaurants and hotels. I agree with that. But the reason we're adding those kinds of jobs is because many of the middle wage job openings go unfilled each and every day, whether for commercial truck drivers or machinists or welders or carpenters or electricians or plumbers. In other words, there's an opportunity to vastly increase or expand America's middle class. And the fact that we're not doing it is not evidence that the economy is not working for people. It's evidence that for whatever reason, they're not finding their way into these opportunities. And again, the public sector can play a major role in that. But because unemployment is low, because you and I are chasing employees, working so hard to recruit them, no surprise, wages are growing pretty rapidly. This is the employment cost index, fastest wage growth in about a decade in America. And because more people are working and because they're earning more money, they're putting more stuff in the baggins. This is expenditures, consumer expenditures. You've heard that about 70% of the U.S. economy is consumer spending. Well, so that part of the economy, the 70% part of the economy, is doing quite nicely. So I don't like this measure. I like retail sales. Fine. Same thing. Consumer shopping. And yes, some of it's online, some of it's here in Hunt Valley, so on and so forth, but they're out there. I mean, there are people out there in Hunt Valley right now shopping. They're there. I mean, if we went, they'd be there. At Claire's or whatever it is. Here's the miracle of this economic cycle. Here's the miracle. So a lot of the last 2 years, at least for me personally, have been spent unlearning economics. Because I was taught certain things. I was taught that as unemployment fell, inflation went up. It's called the Phillips curve. If we get to full employment, we're going to have an inflation problem. And we're basically at full employment. And yet, miracle, this is the Consumer Price Index, the core CPI, and this suggests that inflation is running at 2.2% year over year, just a bit above the Federal Reserve's 2% target. We do not have a major inflation problem in America. I should point out that inflation is different from cost of living. So cost of living might be rising rapidly, but that's because the nature of what you're consuming is changing. I'll give you an example. I now have an iPhone 11 Max Pro, which of course gives me credibility, but it's bloody expensive. But that's not really a case of inflation, because if I tried to buy something like this that had this much power and capability 20 years ago, it would have cost much more than what I paid for it, as it turns out. In some sense, this is cheaper now when you hold constant for quality. The same is true for computers and so on and so forth. So we have a tendency to notice things that are going up in value, triggering lots of inflation, like apartment rents and tuitions. But sometimes we forget about the fact that certain things, like natural gas, have actually become cheaper over time, and therefore electricity. And when inflation is not problematic, interest rates have a tendency to be lower. Interest rates are hobbit-sized. So what do we have? We have an economy in which more people are working, more people are making more money, wages are rising, borrowing costs are very low, and you have the perfect ingredients, therefore, for a real aggressive consumer spending cycle. Here's the 15 and 30-year fixed mortgage rates. Money is cheap. Money is plentiful. And increasingly available, even to folks with poorer credit scores. And we've seen that also over the course of this economic expansion cycle. So no surprise, we got more people working and more people borrowing money and so on and so forth. Property values will have a tendency to rise. If you talk to realtors, they will tell you, yeah, we got a lot of buyers. We got a lot of folks, including millennials now, who are looking for homes. And the millennials coming of age. The most common age in America this year is 28. So if you play a strange game with somebody and say, I'm going to put an American in front of you, guess their age, you would guess 28 to maximize your chance of being correct. The second most common age in America, 29. Third most common age in America, 27. It makes life difficult as they tend to be obnoxious. But they're coming of age. They're starting to form families, so on and so forth. And And so when you talk to realtors, say you've got plenty of people looking for homes. The first-time home buyer market is particularly active, but we just don't have that much to sell them because we haven't built many new homes, and people have stayed in their homes and so on and so forth. And that dynamic creates a basis for rising home values, and that's exactly what we observe. And so home builders look at those rising values and say, well, maybe we should be building more stuff. So this is a measure of building permits. The kingdom is under construction. We saw a real surge in single-family housing permits, which is an intention to build late last year. This also relates to manufacturing, as it turns out, because there are a lot of manufactured items that go into home building. Some of it imported, some of it not. But home builder confidence is now at a 20-year high. And one of the things you can expect to see is that the single-family housing market will be stronger in 2020 than it has been for quite some time on the construction side of things, not just the demand side of things. And then there's the stock market itself. And I have to tell you, I mean, I'm up here. I don't have access to data right now. My guess is it's up. I mean, it seems to rise every day, so that's the guess. This slide is entitled, "But It Goes to Elven." So that makes you recognize, of course, that there are elves in Lord of the Rings, and we'll talk about them more, as it turns out, in a moment. But this also requires you to know something about a movie that came out in 1984 called This Is Spinal Tap, and a line out of that movie. And if you know what I'm talking about, this, in fact, is hilarious. But the point is, I've graphed for you the S&P 500, the NASDAQ Composite, the Dow Jones Industrial Average, record highs. And so what do you have? Cheap money, a lot of wealth being created in the housing market, in the stock market, more consumers working. This economy is really working, as it turns out. But it's not that everything is performing brilliantly. I'll give you an example. Corporate profits no longer really growing in America. They're really flattened out. And maybe that's a nice segue to 7 factors dwarfing hope. That, yes, as this expansion has persisted, some traps have formed. I'll give you some examples. So one of the issues is that not every sector has performed equally well. So while the consumer spending part of the economy has been strong, the business investment side of the economy actually has been quite weak. It was quite weak last year, strong in 2018. That was the first year during which those corporate tax cuts were implemented. But 2018, we saw a real tailing off in business investment. And when business investment falls, it tends not to be good for manufacturing. Global economy also weakened last year. And of course, the trade wars were ever present. And so this is the Institute of Supply Management's Purchasing Managers Index. Any reading below 50, and you see the black 50-yard line running west and east across the slide, any reading less than 50 means that manufacturing itself is in recession. Manufacturing has been in recession for the last 5 months. If you don't like this measure, you think it's too esoteric, here's the value of U.S. manufactured shipments. This is percentage change on a year-over-year basis. It's negative. A lot of this has to do with the U.S. auto sector, which in terms of activity seems to have peaked circa 2016, has been weakening ever since. We've now had a lot of leased vehicles coming off of lease. They're really in quite good shape. They trade at used car prices, and that competes, of course, with the new product. For some people associated with the automotive sector, including petroleum dealers, I sense real panic in their eyes, because every time they see a Tesla, they know that's an existential threat to them, and they're going to see more of those. So lots of change out there, and so this affects manufacturers in various ways. But you can see the last period has not been very good. That said, we now have a first phase trade deal with the Chinese. The USMCA, which is the new NAFTA, the U.S.-Mexico-Canada trade agreement, USMCA. It is the worst named trade agreement in the history of the planet. I'm sure they could have come up with something better and smoother, but nonetheless, now that that's been ratified by both the House and the Senate and goes, I believe, to Donald Trump to be signed now, those trade uncertainties have dissipated a bit. There's actually evidence to suggest that the global economy in 2020 is firming relative to that weak performance in 2019. Part of that probably relates to the fact that we now have some of these trade deals in place. The Americans also signed a trade deal with the South Koreans in 2018. And so things seem to be getting better out there along this dimension, but that does not mean that there's still not some traps out there. This is the U.S. share of global manufacturing value added back to 1970. So one of the questions is, can we regain some of this? And the effort is there. I don't know how people feel about the president. My sense is love or hate, almost nothing in between. But I think one of the reasons he's president is because he spoke to this. And he spoke to communities that, where there was a lot of hopelessness and so on and so forth. He said, well, actually, we can turn this around. We can do this. a lot of people didn't believe it, but, there's reason to believe that, in fact, we can regain some market share, and perhaps some of that's already happening. It's actually also a public health issue. I don't know if you've seen this study. A newly published study by researchers at the University of Pennsylvania, Yale, Harvard, and Massachusetts General Hospital, all accredited institutions, finds that counties where auto plans closed see significant spikes in fatal opioid overdoses within 5 years. Compared to counties where auto plants had not closed, opioid overdose deaths were 85% higher among working-age adults in communities where an auto plant had closed within the past 5 years. And so there's a growing sense of understanding between hopelessness and the effect on public health outcomes. And one of the things that has given people hope historically is the opportunity to work in manufacturing, to make a middle income or better. In our state, as of November, the average wage in manufacturing in our state, as I say, $28.45 per hour, which is a bit above the national average. That is a solid middle wage, and that's the kind of thing that gives people hope. When they lose that kind of opportunity and then cannot replace it, because in retail, the average worker makes about $15 or $16 an hour, for instance, that's what breeds hopelessness and these kinds of very poor outcomes. And I will say, again, while we have that first phase trade deal in place with the Chinese and the global economy seems to be firming just a bit, when you look at the National Association of Manufacturers Outlook Survey, the current business outlook, at least as of the fourth quarter, manufacturers were still saying, hey, we sense some weakness in front of us. Maybe this opinion will change now that people have a firmer understanding of what's in that first phase trade deal, so on and so forth. You might remember that on December 15th, we were supposed to get more tariffs on Chinese goods, this time in the form of consumer electronics in particular, right during the middle of the holiday shopping season. And what the first phase trade deal does is it takes that off the table, at least for now. And I think that has really helped. And maybe some of those dynamics are not really reflected in this outlook, but will be reflected in the first quarter survey. And as I say, there are more vulnerabilities. Here's another one, our national debt. I could easily make the argument, and this is debt held by the public as a percent of GDP, but I could easily make the argument that America is growing, but for the wrong reasons. How could I do that? Well, we don't have final GDP data for 2019 yet, but best guess, the U.S. economy last year grew 2.2%. Best guess. I showed you some measures of inflation, at least one measure of inflation. There's another that suggests inflation is well below 2%. The core PCE deflator. The PC stands for personal consumption expenditure, says that inflation is running at 1.6% year over year. I see some young people in the audience. It's Friday. You might find yourself tonight in a bar, tavern, or saloon. If you blurt out the words core PC deflator, let me assure you, you will not go home alone. But let's say inflation is running around 2%. Let's just say, so if real economic growth is 2% and inflation's at 2%, that means that nominal economic growth is 4%. If we don't adjust for inflation, nominal GDP growth in America is about 4%. The national debt, as you know, is now $23.2 trillion. The federal budget deficit as a fraction of GDP is nearly 5%. So during the last calendar year, we just received these data from the government, during the last calendar year, as opposed to the federal fiscal year, the nation's national deficit, the annual deficit, was $1.02 trillion. We produce around $21 trillion in output a year as a country, so it's not quite the federal budget deficit as a percentage of GDP is not quite 5%, but it's roughly 5%. And if you take that 5% deficit spending away from GDP, this economy is not growing at all. So you could argue that we're growing for the wrong reason. And by the way, it's not just the federal government that's taking on massive amounts of debt. It's also the consumer. And this is not surprising. This shouldn't surprise anyone. Interest rates are low, whether on auto loans or on mortgages, so on and so forth. And, of course, you've got those great deals on credit cards. 3 months, no interest. Just transfer all of your balances. And then we'll charge you 17% after that. But people have taken on a lot of debt. Here I'm showing you stacks of debt. Mortgage debt is in orange. Credit card debt is in blue. Student loan debt is in red, so on and so forth. In nominal terms, the American household has never been this indebted. And again, it's not surprising. Interest rates are low, so it's the same thing. You keep cookies in front of small kids, what are they going to do? They're going to eat cookies, especially if they're Oreos, because Oreos are delicious. You keep low interest rates in front of people, what are they going to do? They're going to forget what they did last time when things fell apart for them, and they're going to start taking on more debt. That's exactly what's happened. As it turns out, the same is true for American corporations. Corporate indebtedness has never been greater. which may surprise you because I showed you a slide showing that corporate earnings have been quite high, have been rising and stabilized at a high level, though they're no longer really growing. But this is what happens when companies buy back their shares every year. You issue debt to buy back the shares, debt goes up, equity goes down. This is a trap. And then it's not just Americans that are taking on more debt. The entire world is so indebted. The Institute of International Finance concluded that as of the initial stages, the first half of 2019, total global indebtedness had topped $250 trillion. Best guess is that by the end of last year, it was $255 trillion. That's equivalent to about 320% of global GDP. We've never seen numbers like this. And again, why has the world taken on so much debt? Well, why not? If it's there to borrow, why not borrow it? Pay it back later. There's actually a group of folks who believe that this doesn't matter. That, for instance, when governments take on debt, it doesn't matter. They call themselves modern monetary theorists. The notion being that government can borrow as much money as it wants. Don't worry about paying it back. Debt does not matter. The number one candidate on the Democratic side in Iowa recently was asked, what would happen if we have a debt crisis in America? What would we do? Just print money. We just print money, pay it back. What's the problem? Well, that's exactly. Inflate all kinds of stuff. The whole banking system would fall apart, for instance. But, set that aside. And they base this modern monetary theory on the fact that over the last 4 decades, the world has amassed massive amounts of debt, and yet interest rates have gone down. This is another aspect of unlearning economics. I was taught that when the public sector takes on a lot of debt, interest rates rise for everybody, that public debt crowds out private investment. And yet, here we have the largest national debt in American history, and interest rates are rock bottom. 10-year Treasury today is yielding around 1.80%, just a little bit above inflation, depending on how you measure inflation. So there's that. But, I think debt matters. I think, and why do I think it still matters? As long as creditors care to be repaid, it matters. So my primary mortgage is with a bank called Howard Bank. They do a lot of business, as it turns out, in Baltimore County as well. And when Howard Bank sends me a letter that says, look, Anirban, you've had this mortgage with us for 7 years, 84 consecutive mortgage payments. It's unbelievable, almost unprecedented performance by you. Fantastic. Thank you so much. The last 23 years on us. Don't even worry about it. It's just fine. Then I will agree with those modern monetary theorists and say, yeah, you're right. That doesn't matter. You're right. I was wrong. But until that happens, all this stuff has to be repaid to somebody who expects to be repaid. And that is a trap. Then, another thing, productivity. So we have seen over time some increases in labor productivity in manufacturing, but this is for the broader economy. This is labor productivity growth in the broader economy. I entitled this slide Entish. The Ents were the trees in Lord of the Rings, featured most prominently in the Two Towers, the second of the 3 movies. And as it turns out, in general, generally speaking, trees don't move very quickly, and neither apparently does the American worker, because during the 3rd quarter of last year, productivity, as you can see, actually declined. Part of that was because they had less to do. Manufacturing and certain other segments were slowing during the 3rd quarter, and so there was a bit more idleness, less opportunity to produce output on a per-hour basis. But this is a general proposition. U.S. productivity has risen at an average rate of 1.3% since 2007, compared with an average of 2.1% since the end of World War II. And again, I think part of this has to do with the way we train workers and so on and so forth. I think part of this has to do with generational change as well. That baby boomers, now retiring in large numbers, have really been committed to the cause, whether in construction, manufacturing. These are people who gleefully entered manufacturing. That was, in fact, their dream growing up. They wanted to work in the factory. Young people are different. They strive for things like, and I'm told this, work-life balance. And what that means is not that much work, lots of life. So what are you going to get? You're going to get slower productivity growth. And then, of course, there's still that lingering political uncertainty, point number 6 of these 7, uncertainty across the realm. This is the Global Economic Policy Index. It's a measure of policy uncertainty. It's amazing how things go. This is impeachment week in America. Welcome to the week. Last week was War with Iran week. I don't know what next week will bring. Who knows? But something big. And it seems like we just narrowly skirt by all these kinds of things. And we were asking the question this morning, did the Iranians mean to miss? Was that on purpose? We can't even tell. It could have been a disaster, but we seem to skirt by. And so that uncertainty is still there, whether in the Middle East or other parts of the world. And then finally, asset prices are very high. And what goes up can come down. I don't have to tell you. This is a favorite measure of mine. This is a Shiller price-earnings ratio. sort of, relationship between the price at which shares are trading on the S&P versus the earnings of those same companies. There's only been one moment in recent economic history during which price earnings were significantly higher, and that was just prior to the dot-com bust of 2000. There was a joke a few years ago, oh, my 401k is now a 201k. You probably heard that joke. Not a funny joke, as it turns out, but my 401k is not a 201k. Well, now it's an 801k. But in 2000, 2002, and then again during 2007, 2009, the S&P 500 fell 50% roughly during each occasion, which, as it turns out, gets you back down to a 401k, as it turns out. I'm not saying that's what's going to happen. I'm just saying that as the market has risen, there's more room to the downside. And so, I'll get to the forecast in a moment, but I want to admit something. There are certain things that I failed to predict, and I think almost every economist failed to predict. Why? Because we learned economics too well. So, for instance, I was taught, as I say, low unemployment, higher inflation. We've had impossibly low inflation. What feels like impossibly low inflation. How could one have seen this coming in the context of the lowest unemployment rate in 50 years, lackluster productivity growth, a robust consumer spending sector, and the lengthiest expansion in American history? But that's been the miracle. Why have we not seen more inflation? Number of reasons. Number one, weak global economy. The world's people have a capacity to produce a lot of things, but when their domestic economies in Europe, Japan, elsewhere are weak, they can't necessarily consume those things. They don't have the money. Where does it go? Off into America. And that pushes down on domestic prices, the prices that face our consumers, our distributors, so on and so forth. Second reason, I would call the Amazon effect. What is Amazon about? It's about squeezing fat out of supply chains. Because when you go to Amazon, now the consumer is so empowered to compare prices for any commodity. And they can see what the lowest price is for that good, and they can see also the consumer's experience with that good. That's empowering. But it's also disinflationary or deflationary, that level of price transparency. When I was growing up, I grew up in Kankakee County, Illinois, on the Indiana border, farm country. And in Kankakee, when we went to buy, let's say, clothes, you went to Sears, Roebuck and Company, which is also where you bought your farm equipment and your tools. Not a center of high fashion. You can't do all of those things well simultaneously. It's impossible. So, but if you want to get really gussied up, I mean, really into the nines because you're going to prom or you're in the school play, which I was, by the way, I was a lawyer. You'd go downtown, and you'd go to this place, this boutique known as JCPenney's, and then you could get some really amazing merchandise, some of it coming as far away as China. And so, and then at JCPenney's, you'd have that rack of shirts that was $5.99, another rack that was $7.99, another rack that was $9.99, and that was your price transparency. Now, what do we have? Some other factors at work. This current administration in Washington, D.C. has very much emphasized deregulation. You may think that's good policy or not good policy, but compliance costs have generally gone down, including for energy suppliers. So there's a number of factors that have mitigated against inflation, but still very difficult to have predicted. Incredibly low interest rates. How can global indebtedness be so high and global interest rates so low? I don't know. And then finally, the strength of the U.S. economy itself. How can the U.S. economy, I don't know. I just don't know. But how can the U.S. economy have been performing so well and financial markets booming so splendidly in the context of fragmenting global trade, slower immigration, Brexit, impeachment, global warming, and other phenomena that one would think would be bad for domestic economic outcomes? I mean, you've been hearing the news lately from Australia. Australia is on fire. The continent is on fire. What did the stock market do yesterday? Record high. So how does one predict all of these things? It's very difficult. And, of course, manufacturing. There's certain things that we'd like to predict about manufacturing, for instance, the nature of emerging technologies. So I don't want to go through this. The fourth industrial revolution, or Industry 4.0, is sort of the current terminology for the change taking place. At the heart of the latest industrial revolution is what global data describes as, quote, enhanced human-machine interaction to drive interconnectivity, information transparency, and autonomous decision-making. A number of technologies that are key: big data and analytics, industrial Internet of Things, cloud computing, additive manufacturing, including 3D printing and augmented reality. So things are changing out there very, very quickly. The point I want to make, just want to go to this last bullet here. This could open up new avenues for manufacturers to recruit and retain tech-savvy millennials. Because the millennials have, in many cases, avoided industries like construction and manufacturing. Well, they've been taught what? Go to college, get a job in an office building. The goal, to get out of a cubicle into an office and then the corner office. And manufacturing doesn't seem to fit into that kind of context. But with the new wave of manufacturing technologies, it might be an opportunity to recruit and retain tech-savvy millennials who may have an easier time embracing a more technology-driven workplace. Just an idea. And so with that, I give you the one forecast, the final slide of the presentation. Look, I know that the ball is rolling down the fairway quite nicely now. This economy is moving. In fact, in certain ways, we're gaining momentum in 2020 vis-a-vis 2019. Have that first phase trade deal, so agriculture and manufacturing stand to be maybe a bit stronger in 2020 than they were last year. Global economy is stabilizing, so on and so forth. But I still think risk of recession over the next 18 months is arguably more elevated than any period since 2007. Why? Because we have all this debt. And maybe the laws of economics will eventually come to the fore again. Maybe we'll get inflation when we're supposed to get inflation. And therefore, interest rates rise when we're supposed to rise. We shall see. And then, of course, we have the elections coming up later this year. And you say, Anirban, this should not be part of the forecast because presidential elections take place every 4 years. It's not a big deal. It's a big deal. Why is it a big deal? Because the policymaking distinctions or differences between the potential presidents is so massive this time around. All I'm trying to say is the obvious. There's a big difference between Elizabeth Warren and Donald Trump. There is. There's a big difference there. Those are two very different human beings. There's a big difference between Bernie Sanders and Donald Trump. There's a big difference between any conceivable human being and Donald Trump. And I do not say that in the pejorative. I said something similar in Harford County yesterday. Harford County voted 78,000 for Donald Trump, 47,000 for Hillary Clinton. I'm not saying that in the pejorative. I'm saying that because there are going to be a lot of economic actors who are going to adopt a wait-and-see attitude as we hit those third and fourth quarters. If you run a health insurance enterprise, the people of this room may agree with unanimity that Medicare for all is the best public policy possible. But for a healthcare insurer, that's an existential threat. So they're not going to be taking more office space or hiring more people as we head toward this election. In fact, the priority stopped. If you are an energy supplier, and the number one candidate on the Democratic side says CEOs of energy companies are evil. Now, I'm agnostic with respect to that statement. Maybe they are, maybe they're not. But that's a vast departure from the current administration. And if you don't know if you don't know whether or not that's coming and the regulations that relate to that, you might adopt a wait-and-see attitude with your next set of investments. So there's that as well. Ultimately, I think the next 12 to 18 months could simply be a soft landing, like 2016, a year during which the U.S. economy only grew 1.5%. But here's what I think. Businesses should be raising cash. Why do I say this? I remember in 05, 06, 07 that a lot of construction firm owners took that time to buy for themselves or their significant others $1.5 million homes. They took cash out of their businesses. They didn't realize that they were going to need that cash in their business when the downturn came. So that complacency should not be there. I think it's a good time actually to raise cash while profitability is high and the economy is strong. Determining if their line of credit is large enough. I'm a small business owner myself, and so I take some pride in the fact that this morning my line of credit balance is zero. But that doesn't mean I'm not going to need it at some point in the future if things turn downwards and RMI no longer asks me to speak. Considering staffing models, who's really indispensable? One of the things that happens during good times like this, you're taught in business you want the right people on the bus. You hear that a lot. You want the right people on the bus. But when no one's lining up to get on the bus, it's hard. And so what might happen is there's a tendency to carry underperformers during times like this because you got to get the work done. And you sort of manage around that. And then those people are the first to be let go when things turn bad. It's important to understand who's indispensable to the business and who may not be, to think about that beforehand while one has time. And then ensuring the good graces of bankers and insurers, because they often determine whether or not a business survives during bad economic times. If they continue to maintain that line of credit for you and make that loan when you really need it, so on and so forth. What I've said to people is, look, the economy is good right now. You should be, you should be giving the bankers, the insurers, the Joe Biden treatment. Smell their hair. Really cozy up to them. Maybe over dinner and some candlelight. That kind of thing. And then finally, households should consult a trusted financial advisor because we've got some real big changes out there. First of all, of course, there's that risk that comes from a period during which after which the stock market has really risen. But we also got something called the Secure Act that was passed last year by Congress. It really changes a lot for retirees or near retirees. It's something that you probably want to talk to your advisor about. And that's my presentation for the morning. Thank you very much for the opportunity. It has been a privilege.
Just to make sure, you will always be included and invited in our events.
Okay. No, I'm not going to just keep my current line of credit the way it is, though.
All right. Now it's time to get from the audience your questions, comments, whatever. Yes, thanks, Stacy. So who's got?
Yes, we have a few minutes for questions before the panel. We have a wonderful panel coming. But
so you know, it's interesting. You said as an economist, the rules have changed, and that really struck me because I think that's probably applicable in other areas as well. And we're trying to figure out what are the new rules. At least that's, thinking about what's happening in your world. Similar is happening in other aspects, particularly in manufacturing. Somebody's got to have a comment.
Question over there.
Right there. And over here, anybody?
Mike, we have one over here.
Okay.
Hi. So Maryland, manufacturing. I think there were about maybe 3 sectors. I heard one of them that you talked about of the slowdown, and other sectors, that the slowdown wasn't going to affect other sectors. So I think it was auto, electronics. I can't remember the third one. But what about Maryland? Which sectors, based on what's going on, are going to stay strong?
Right. So the question is, which sectors or manufacturing sectors are going to stay strong in Maryland? Well, you got to think defense electronics first and foremost. I mean, my goodness, how much money is being spent on DOD, but also Homeland Security, so cybersecurity, for instance. That's where I see the real procurement strength. This economy is driven by 2 things: government, direct government or agency activity, and procurement. Those are our industries. That's what the auto industry is to Detroit. Federal government contracting and federal government employment is to us. And in 2013, when the sequester was passed and implemented, this economy came to a dead halt. Now the federal government is running $1 billion deficit each and every year, which might alarm many people, and it should be alarming. But for Maryland's economy, it's terrific. So, those are some of the segments. I would think that the auto sector will continue to be sluggish around here. So we have some parts manufacturers around here, actually in the audience. That seems to me a flattish segment of the economy. It's just harder and harder and harder for these manufacturers to put forth sufficient incentives to get the consumer to buy. So they're having to discount massively, and that puts further pressure on the suppliers to those, manufacturers, the Nissans and so on and so forth. Nissan is having a tough time, as everyone knows. So those are some of the answers to your question. You're in chemicals, everyday chemistry, and that should continue to be a quite strong segment of the economy, I would think, because there's a real demand right now for value-added chemicals, and also there's a lot of work taking place in material science. People are looking for lighter materials with certain features, and there's been a lot of progress along that dimension at an atomic level. And so I think you'll see a lot of demand for that as well. But for basic household goods, a little bit flat for a lot of those things. Any other questions here? There's a question here.
We're trying to keep and retain workers in the manufacturing area, obviously here in Maryland, for all of our businesses. But what about legislation passing such as Kerwin? How's that going to impact all of us here?
Right. Great question. So I have to be honest. I do a lot of work for people who have been on the Kerwin Commission. I've studied this a lot. So I want to stay, neutral as best I can. But it's an expensive proposition. And, it's been said that after 10 years of implementation, Kerwin will cost $3.8 billion per year. If you read the report, it's actually $6 billion. And why do I say that per year? Why do I say that? Because there's certain things that are built into that $3.8 billion number that probably shouldn't be. I'll give you an example. They expect, the people on the Kerwin Commission, that the special education population will be cut in half over that period. If you take away the savings associated with that and do some other things, it's actually $6 billion, not $3.8 billion. So in other words, the $3.8 billion already includes some of the cost savings that are expected to be delivered by Kerwin, as an example. So that's, a lot of money. I would say this, that, and I probably should not say this, the Kerwin Commission people will say that every aspect of their recommendations is important, that it's all synergizes together. You can't do one thing and not another. That's what you will hear. Still, I think that there's certain things that are in there that are more important than others. Number one, in my mind, a second pathway to high school graduation. So one of the proposals is allowing students to gain vocational certificates to be industry ready upon 12th grade graduation. I think it's brilliant. It's going to cost money. It's true, but we have a lot of people who graduate from 12th grade who are completely lost in this world. They're not going on to college, or maybe they do and they drop out almost immediately. And then they've got no place. They don't have a credential beyond a high school education, and they've got no real specialized skills. They're lost. They're lost. This would give them a pathway to say, okay, there's another pathway to graduation. We're going to link you with employers. We're going to provide you with relevant skills, training, so on and so forth. We're going to set you up with the community college, so on and so forth. You might actually get some college credits while you're in high school, as it turns out. I think that's exactly where we need to head, that one size does not fit all, and so on and so forth, and that there is, yes, college is good for a lot of people. Don't get me wrong. The typical college graduate makes about 82% more than a typical high school graduate. So there's that. But it's not for everybody, and we have to have another pathway for groups of people. And in Germany, of course, it is quite often that, that if somebody successfully completes an apprenticeship program, they get their name in the newspaper because such things are held in such high esteem. So we have to change our attitude as a country, and we have to, come around this. It's not just about college preparedness. That's important, but it's not all of it. And I think we're starting to recognize that, and it's built into the current commission. The second thing I would say that's important is the expansion of pre-K. And to 3-year-olds and 4-year-olds. The reason I say that is, and I should not say this either, but I think one of our real big problems, and not just in Maryland but elsewhere, bad parenting. I think we have some really lousy parenting taking place. And I judge that from their children. And so, so if you can get some professionals into their lives when they're 3 and 4, get them into a broader social network, interacting with others, it might create some really beneficial social dynamics that you otherwise don't get. And by the time they're in kindergarten, 5 years old, they're too far behind. And by 2nd grade, even more, so on and so forth, and they get more and more frustrated. And then by 4th grade, it's all over. So those are 2 things, and that would not cost you $6 billion per annum. I think that would generate a lot of value in and of themselves, even without some of the other recommendations being implemented. I should not have said that, but that's what I believe. Any other questions? Yes, there's a gentleman here.
Hold on.
You talked about asset prices, and some of us in the room are interested in private equity investments and buying and selling companies in the private markets. Can you comment on that a little bit? You talked about PDE ratios in the public market, so asset prices there, but there's a lot that goes on there. There's a lot of debt that's been taken on in the corporate sector to help inflate those private equity prices. And in the event of some kind of pullback, you hear about money on the sidelines. Can you prognosticate at all there with all that stuff that's in the mix there?
Yeah, great question. I think it's another source of risk. So some of us might remember the late 1990s and the role of venture capitalists in spawning ultimately that economic downturn, lending investing, I should say, all that money in .coms and so on and so forth, emerging technology companies, and the valuations taking off, and then those companies would come to initial public offering, and the valuation would go even higher, and the public would now be at risk from falling asset price. I think some of that's happening now in the private equity space. That there's a lot of excess there. There's a lot of leveraging up of balance sheets. You have many successful enterprises like, Toys R Us. I've met some people who don't like Lyft, don't like Uber. I've never met anyone who doesn't like Toys R Us. So how could they go out of business? If you're universally loved, how can you go out of business? Because a consortium of private equity firms came together in the mid-2000s and leveraged up their balance sheet. So when the Amazon effect came to the fore and they had to compete with Amazon, they didn't have enough free cash flow to compete. They went bankrupt. Same thing. I mentioned Claire's earlier, which is at Hunt Valley. They're bankrupt. They went bankrupt in 2018. Why? Because the private equity firm leveraged up their balance sheet. And I think you see a lot of that in corporate America right now, and it creates a higher return on equity while things are good, but it creates that vulnerability. As you know, last year was a record year for store closings in America. A lot of retailers are struggling, so on and so forth. And I think you'll see this spread into more segments of the economy, including tech. I know tech is raging right now, including the semiconductor manufacturers, so on and so forth. But watch out. There's a lot of indebtedness on those balance sheets, and I'm worried that these valuations are too high. It's hard for me to say that because I don't know, in some sense, what I need to know about these private firms. They're private firms. Their data are not public. But this is my very strong sense. And you saw this with a company called WeWork. When it went to go public, it was privately held. They went to go to initial public offering. They had to release their data to the market, and the market said, my God, you're a disaster. And they don't go, the CEO left and all that kind of stuff. And my guess is there's a lot of private firms out there, privately held firms out there in the same situation. And if their data were brought to light, it would not be a pretty picture.
I get to ask the last question.
Last question?
Yeah. If you were governor right now,
yes.
what 1 or 2 things would you do that would make a difference in terms of growth of Maryland manufacturing?
Right. If I were governor of Maryland, first thing I would do is I would fire the entire Baltimore City Council. And in all seriousness, we had 348 homicides in the city last year. We had 50 homicides in this county last year, which is up, from 27 the year before. So we had 398 homicides in the core of the metropolitan area. Why do I bring this up? It becomes very difficult to recruit to Baltimore when you've got this kind of narrative. Over the last 3 years in Baltimore City, 999 people have been murdered, 348 last year, 309 the year before that, 342 the year before that. So we murdered 1 out of 600 city residents in 3 years. Over the course of a generation, that's 1% of your population that you would have murdered. A generation being 18 years, let's say. So that's the kind of criminality we're talking about. Not to mention all the people who are shot. I think it's a big deal to be shot, even if you don't die. That's a big deal. But we don't try to say, oh, you shot, but he lived? It's like a broken windshield. What's that? That's nothing. Why are we making a fuss about this? It's a big deal. And that, I think, really holds back our economic development in Maryland, really holds back our recruiting. And, you asked about manufacturing. If the question is about manufacturing, it's all about the community colleges. It's all about vocational training in the high schools. And call it vocational training. Because what they call it right now is career and technical education, so no one knows what you're talking about. But it's vocational training. We need more schools like Harvard in this county, that really train people for occupation, so on and so forth. Really synergize between industry and education. It's not for everybody, don't get me wrong. There are a lot of folks who just want a liberal arts education. Great, we need to offer that too. But two things: solve the public safety crisis in Baltimore City and elevate the state's reputation as a place in which to live and do business. And second thing, really think about how we can impart relevant industry skills to people earlier in life so they're not lost upon 12th grade graduation. I thank you for the invitation.
Thank you, Anirban. And I just want to say the head of career and technology education in Baltimore County is here today, and we work very closely with them. So, Doug, I know you were here earlier. Thanks for coming. Thank you, Anirban. So at this time, very quickly, we'd like to ask, the second part of this is for you to hear from manufacturers and how they're seeing the future for their business, and also for them the opportunity to make any comments regarding the conversation we had before as it relates to the future of Maryland manufacturing. So I'd like to ask the three panelists, Suzy Ganz, who is also the vice president of RMI from Lyon Brothers, to come on up and have a seat. Douglas Hamilton, CEO, Hamilton Associates, another board member of RMI. Please join us up here. And John T. Williams, who is the CEO of Jamison Doors Company. And I mentioned earlier how this was kind of like a reunion for RMI. I remember when we started RMI 30 years ago at Dundalk Community College, about a year or two after that, we were actually, interacting with Jamison Doors. So, John, it's good to have you guys back with us with RMI. So I'm going to pass on some, in case, here's extra ones. All right. So again, each one, we're going to go down and ask each one to talk for a few minutes about their company and how they see the future for their company, and then I'll come back around and we'll talk. We'll get some questions from the audience, or I'll raise some questions. So, do we want to start with John? Jamison Doors. Tell us about the future of your company.
There are a lot of things in life that are unfair, and one of them is following Anirban. Usually you have the warm-up acts first. And then the main event. In this case is a little different. Let me first of all tell a couple of things about our company. We were started in 1906, and we make doors for refrigerated and frozen food facilities, most of which you've never seen. We've gone on and added a lot of different products. We're based in Hagerstown. We in 2004 bought an air door company, which I'll talk about in a minute. We started a joint venture in Mexico City to make doors. We later, a few years ago, formed a joint venture with a company from Italy to make high-speed roll-up doors, and we're expanding that. And we make fiberglass doors, which are in food processing facilities. So we've grown, we've developed quite a bit. I'm a native Texan. I'm sure you can't tell from my accent. So everything he says about Texas, I would second and say, I got associated with Jamison Doors in the year 2000, and it was like moving to the People's Republic of Maryland. And when Governor Hogan came, it really changed the attitude of state government, and there are a lot of war stories about how that happened. What we've done, the good news is from our business, we're in the food business, or have been historically. That's been the base of our business. So people have to eat in good times or bad. So there may or may not be that many new facilities, but in renovations and just maintenance of facilities, where there's some floor to the amount of business that we get. But in good times, there are a lot of new facilities, and so life is good from that standpoint. So the economy truly has a significant benefit to us. And then when Trump was elected, in our situation, literally the day after the election, the business climate changed with the understanding that there was going to be regulatory reform and tax reform. And that mindset had a material impact upon our business and the business climate. And so as a result of that, and when regulatory reform really started to take place and the tax reform was actually enacted, then there were really tangible benefits to our business for that. We have expanded, we built and moved a much smaller facility into a 50,000 square foot facility to build the high-speed roll-up doors and add lines to that to let us get in general industrial applications. We were able to pay a bonus, which was a week's salary, immediately after the election, and we've done that week's salary to every person on the payroll twice a year since then, because we've been profitable, and we were not always profitable. Times were pretty ugly in the past. We were able to pay dividends. We were able to make substantial investments in new technology that let us become a great deal more efficient. So the economy has had a significant effect, and we really became the poster child for what tax reform and regulatory reform was supposed to do. So much so, in fact, that at the board meeting of the National Association of Manufacturers last year, that Vice President Pence got up and cited our company as one who had done exactly what their legislation and regulatory reform was designed to do. So the economy clearly has a major impact. One thing that Anirban mentioned was what private equity groups have done. We love it when a competitor gets bought by a private equity group, because their time horizon is 5 years. We're going to buy the company, we're going to strip it down. Well, all we care about really is 5 years from now, it's got to have bigger cash flow, and then we flip it. Now, most of you may not be old enough to remember the game Old Maids. Remember Old Maids? So it's whoever ends up with the Old Maid card loses the game. And there are a lot of similarities again, the one company that comes to mind with the company that, or the private equity groups that own this one company that's a big competitor. I think this time they got the Old Maid, which is great for us because it creates a great deal of opportunity. Another thing, just industry-wise, is that there have been foreign companies, not that ship doors here so much, but that buy local companies, and that creates a lot of turmoil in the industry that gives us a lot of openings.
Okay. And hold your questions, obviously, until we get through to the others. Thanks, John. Okay, Douglas Hamilton from Hamilton Associates. Oh.
Hey guys, how are you? My name is Douglas Hamilton. I'm fortunate to be the CEO of a family-held business called Hamilton Associates. That doesn't tell you much about what we do. We're actually, I call us a nano conglomerate. We're three very different industrial businesses under one common management and ownership group. So we have a business that makes elevator components. We have a business that makes instruments that are used for testing specialty filters and filter applications. And we have a commercial-grade pressure washers distribution and retail business that's down in Linthicum Heights. So it's always interesting for me when I hear these talks and we talk about the manufacturing sector. But manufacturing, and I feel this acutely, manufacturing is not a monolith. And there's so many different types of companies, and in our industries, we touch healthcare, we touch government, we touch defense, we touch construction, we touch just so many different pieces and sub-industries. We have a division overseas, a distribution office for our instruments business in the United Kingdom. So there are currency things that hit our business and affect our business. So all these things come together and hit us in very different ways. We're on a growth mission, so we're really working hard to grow our businesses organically, all three of those businesses, and that for us is we're kind of in a messy middle stage. We're a kind of lower middle market company in a generally $25 to $75 million revenue range, and for us to kind of get to the next level of total revenue, it requires us doing a lot of things differently through our whole company. It means top grading lots of different teams. And our old growth strategy was, historically predicated more on saving capital, running our businesses in a relatively conservative fashion, not necessarily trying to grow the businesses super aggressively organically, but saving money to do a fourth platform acquisition. So you can tell, that's kind of how we did grow. That's how we ended up with this mix of businesses. But partly because there's been, first of all, so much competition over the last, really growing over 15, 20 years, this private equity boom that's gone on, as well as the fact that there aren't that many manufacturing opportunities, companies for us to buy in this area, which is really, was a limiter for us. We really couldn't, at the valence level we were, extend our influence into a company that was in another geography. So we're in a long sort of multi-year period of retrenching our entire organization and top grading the whole team, and maybe an overused word, but building processes, process muscle, culture muscle, to be able to do new things that we haven't done in the past, and we've focused ourselves more on organically growing the businesses that we're in. We've been able to enjoy the tailwinds of the last few years. We have double-digit growth a couple of years in a row. And so it's a little bit scary because we continue, our budgets for this year are kind of steady at the helm. We're continuing to invest in the things that we've been investing in. That means IT infrastructure. That means, some personnel. It means deepening our finance expertise, putting new systems into place, new processes across the entire organization, new product development, hiring engineers to develop new products. And that's a little scary. It's kind of a gut check time, knowing that perhaps we're coming into a little bit of a downturn or a slowdown. And we've been layering on investments. We've been fortunate to layer growth on top to cover that. But how much do we want to stay at the helm? And Anirban, you said today, build cash balances. I heard someone else say in a similar presentation, this is the year you don't really want to get caught out, or this year or next year you don't really want to get caught out. And so it's a little bit scary for us. I think for us, as you look at the debt, the corporate debt chart, which was scary for me. Part of the advantage we have as a family business with a long-term horizon is that we don't need to get too ahead of ourselves in the boom time. So I think we've managed ourselves relatively conservatively with debt over a long period of time, so that we can be a little steady at the helm this year and don't have to suddenly shift. So that I guess the time to clean up your balance sheet is really all along. It's a little, you're a little too late to react if you have to pull back all of a sudden. So we're fortunate not to be in that position, but that really comes from a disciplined approach over a long period of time. And I'm fortunate to have people that stand over my shoulders and make sure I don't get too exuberant in the meantime. But I think part of the challenge, and the reason I asked the question about private equity, is that in the meantime, we are competing with private equity companies. We're competing with investors that aren't necessarily expecting the types of returns and aren't exhibiting the same discipline that we are, developing new technologies, maybe moving into our spaces. When we want to do acquisitions and move into a market adjacency, it's tremendously expensive for us to do it. And therefore, although we have done some small acquisitions, we really haven't been in a position to make a splash because we haven't felt that the value is there. So, my hope is that our long-term discipline will start to pay off at some point. I don't know whether or not that's going to be the case. You still hear about, money on the sidelines. I don't know how you measure that. Patriots staffers filming the sidelines to see how much money's piling up there. But the money's chasing returns right now, and will there still be money there chasing a smaller number of opportunities for return, and what will that do when the market starts to turn is something we have our eye on, because obviously we want to participate in that market, but we're also competing with other companies that are in that market. So interesting times, and that's what we're up to.
Thanks, Doug. Okay, Suzy Ganz, Lion Brothers.
Sure. So Lion is a company that was founded in 1899 in downtown Baltimore as an embroidery company. And being in the textile space, we're probably the lowest in the, the least sexy industry you can possibly imagine that relates to textiles and apparel. However, in this least sexy industry, the fun part is that we actually operate a little bit as a tech company. So what we did is in 2012, we decided to grow the company and took what was a legacy platform of manufacturing embroidered identity and began to focus on advances in materials science and technology, brought in a top team at that time. A friend of mine who was actually head of an apparel company over in Asia, and then we brought in a guy who had recently took retirement from our 600-pound gorilla in our stage, which was Avery Dennison. And so, and with this top team, one was from Scotland, one was from the UK, and we have a CFO that's originally from Taiwan, so none of us speak English, the same language. It took us a little while to figure out what we actually meant contextually. But beyond that, what we started to do was to go back to front. We created what we call our Christmas tree. And our Christmas tree looked at everything, and I brought in my friend and said, if you were going to grow the company, what would you do? What would you redo? And he looked under the hood and said everything. And then we brought in a head of operations and asked him, hey, if you were going to redo this company and position it for growth, what would you do? And what would you redo? And he said everything. And so we began with fundamentally redoing everything. And this was in 2012. It took us a long time. Took us years, in fact, to put in the system, processes, people. And what we began to do is get this funky thing that's often you find in technology, which is the effect of the S-curve, which is when you begin to understand things about how technology is out there. And we began to look at things that were different and beg, borrow, and steal from other industries. We began to understand things like laser technology. In the beginning, we were the first in laser technology in what we do. And then we began to advance laser technology in terms of the advancements from regular lasers to then high-speed lasers, and from high-speed to then galvanometric, and from galvanometric to then we began, instead of collaborating, creating, speccing, and now we go from the speeds have gone probably at exponentially, from 1 time to 10 times to 25 times to now 100 times. And what happens in this technology speed is that you begin to have margins that are much like a technology company and reduce the reliance on labor in a production process. But along the way, what we began to also understand is how this works as a system with advances of material science. So we began to look at not just lasers, but their applications in terms of things like advanced adhesives, because everything we do is applied to apparel. So if you ever see a Ravens jersey that has a swoosh on it, that's Lion. We're the exterior decorators, or an Orioles jersey for Nike, or a basketball for the NBA. But if you see a champion that says champion across the front with some sort of textile decoration, that's all Lion. So what we began to understand that this pain point of the industry and retail was about inventory. Inventory in retail and in the apparel trade is a little bit like a perishable fruit. It's a banana that has a shelf life of X amount, and after that season, it's then marked down. And so what we began to offer people was the ability to really decorate faster and faster and faster, to be able to reduce that perishability, and to be able to then, for them to reduce their inventories and markdowns, and to have a material impact on the global supply chain for brands. So as we began to do that, we began to understand this technology a little bit better. We began to understand that instead of making things overseas and shipping, and yeah, we've gone through it all this past year, tariffs and trade and this and that, and China 3 rollback doesn't have an effect on China 1 and 2, which is where we are. But in our industry, there was a tremendous shift to other countries like Cambodia, Vietnam, but there isn't enough capacity in Vietnam and Cambodia to actually change all the sophisticated textile supply chains that are already in China. Did have an impact in terms of the slowdown of the country, but as we look towards what happens in the future, I think people look at more portfolio management strategy. It's not whether I have a presence in China. It's I have a presence in China. I also have a presence in Central America. Also have a presence in Vietnam. So we see this decentralization of supply chains. But for us, it's been a little bit of a story about with technology, it allows us to look and think of things differently. And so as we look at things differently, we began to create things that have to do with automated systems in a way where instead of producing goods overseas, we can produce them here in the United States. So we're about to open and we believe in micro facilities, small facilities that are about 10,000 square feet that are highly efficient with not a lot of people, but a high lot of productivity, where we have attendant people who are engineers and graphic designers and marketing specialists and other around these very, very small production systems. And so we're about to open our second micro facility here, which has to do with just that. It's really advances in material science and the things that I've spoken to you about which creates new products that replace things like screen printing on T-shirts. Screen printing is an analog process, and for us, one of the huge transitions has been from this shift from analog to digital, and to be able to have things that go closer and closer direct to machinery. So ultimately, we can create supply chains that align to demand chains. So it's been a crazy journey. For those in the community that are related to investment, help manufacturers, because manufacturers do need help in everything from understanding the toolkit that's out there, both in terms of the technology from the community here, from banking, again, how do I get from here to here? For us, it was self-funded. From what it means in terms of what it can mean strategically to your business in terms of business growth. We've grown about 40% per year for the past 3 years and had about 15% margin growth. So it's a dramatic, permanent shift. And then what it means in terms of the health of where do you go next? And tons of opportunity in green space. The thing that I also want to suggest, if there are any educators or legislators in the room, is that for those of you that are thinking about the legacy of manufacturing, I want to shift your thinking. There's never been a better time to think about the future of manufacturing, because these centralized systems where production has been overseas have the opportunity to come back. And Maryland is close to customer. As you know, we have lots of distribution facilities here in state, but their ability to be close to East Coast, close to other places, is really a great location to be able to put things that are highly automated, sound, advanced systems in. So please think of us, instead of thinking about the legacy, and again, there's a great legacy manufacturing here, people who do really good work that are generally, for all sorts of industries. But think about the new systems that have the ability to come in as you're thinking about things like education and policy and other, because I'm extremely bullish beyond 2020. 2020 is going to be a low visibility year with all the bumps in place, and I concur with the comments about move boldly and softly with regard to R&D, innovation, and other, because you don't want to get left behind. But by the same token, carry cash.
Wow. Okay, let's give an applause first of all. All right, let me turn to the audience first. If you've got any questions of any of the panelists, Suzy Ganz just said her company's growing 40% every year. Oh,
so
good.
Is this thing on?
Give us your name too.
So I'm David Betts with InSource Solutions, and my question is directed at Suzy. So you're opening a new facility. Is that here in Maryland?
It is. It's in Owings Mills.
Awesome. I noticed your other facility is no longer there, so I'm glad to see that you're staying in Owings Mills. The building, the old building, didn't you tear that down?
We did. So it was an old legacy structure. We learned as we don't want to be in the real estate business. We want those in the real estate business to be in the real estate business, because we were spending too much of our time worrying about roofs versus worrying about R&D and innovation. So we already have our first small micro, which was actually a dedicated facility set up for our loving client, the Girl Scouts. But they allowed us, and here's the value of legacy clients also. They allowed us to be able to collaborate and innovate with them, which was, let's pilot what a micro would be and look like. And today we just set up our second micro. But we'll keep on going with micros. The model that we've created is a model where we can basically pop a factory into a factory. Yeah.
Other questions? I have a question to the audience as it relates. Is there anything, most of you have clients or you touch manufacturers. You don't have to be a manufacturer to be concerned about manufacturing. Is there anything that you're hearing from your clients, your manufacturing clients, that is in addition to what you've heard? Is it similar to what you heard from our panel or from Anirban about how they're feeling about the future of manufacturing? Anybody want to comment on that? Man, it's great to have an engaging audience. All right, let me go ahead. Yeah, go ahead, Bob. All right, back to the workforce issue. Well, workforce, yeah, I mean, Anirban, you put the slide up from NAM. NAM also did a kind of more of an in-depth study on that. Nothing's new. Todd, where are you from Commerce? Mike Kelleher, right? We've been talking about work. We've been listening to people talk about workforce for 10 years, probably. Okay. RMI has always felt that image of manufacturing is tied in to partly responsible for why people don't come. Anirban talked about that a little bit. People still think it's Bethlehem Steel. We're a long way from there. That's why RMI is always focused on promoting positive image of manufacturing. It's a factor in the school system. That's why we don't have the educational programs that you're talking about. If people don't see manufacturing as a place to go to work, even though, by the way, we're one of the top industries in terms of annual salaries. We probably do pay better than Starbucks, okay? But Starbucks doesn't have any trouble. So image is always an issue, and it's particularly an issue with the legislature. The reason why we're not getting support is because they really aren't up on what inside manufacturing looks like today. They need to hear what we just heard here. Or there are other industries that are, quite frankly, have a stronger voice, and they're pushing it. So we're always trying to say manufacturing matters in Maryland. And as we show what's under the hood of manufacturing, MEP has done a great series on videos where you can go inside of a manufacturing video to see what that world of work looks like. So that's really important. I would say, as I'm listening, if you don't mind, as I'm listening to Suzy, we live in a world of now. What are the problems now? It's workforce, okay? It's also technology. That one doesn't come up. It's the lack of knowledge people have about the technology that could transform their company. And I will say, because I know Suzy very well, Suzy Ganz was a leader who went out of her way to understand those emerging technologies and took her company through a very challenging process of changing the culture to embrace technology to be more productive and to bring those jobs back here. So that's another issue. But I think the issue of now is jobs. But the other side of the coin is when. When this tsunami of new technology that Anirban talked about, and particularly artificial intelligence, and particularly robotics, I'm telling you, right around the corner, what the job sets inside manufacturing are going to be radically different. And we will find out that for manufacturing, education, skills, is economic development. And that's what's going to help manufacturing if we can get people thinking that way. And I don't mean to be going on too long, but that's the Suzy Ganz story. I guess the good news is, sounds like manufacturers are doing well in terms of business in Maryland. Does anybody have any other question? Yeah, Sarah? And then, oh, wow, we stimulated some thought here. So let's do this, and then Sarah, and then we'll go to Sarah. Go ahead, Jeff.
Thank you, Mike. Not necessarily just
Tell them who you are. My name,
This is Mike working.
Yeah.
My name is Jeff Schrader. I've worked with Mike in the past on his green program. Most of my clients are not manufacturing, but I'm hearing from all of my clients a very specific thing, and that is employee engagement as being a serious driver for profitability and success. The companies I work with that put employee engagement first tend to have much more rapid growth, much more success, higher quality work. I think that may be even more important than technology in many businesses.
As important, for sure. And by the way, since you mentioned employee engagement, where's Lester Miller? Les, right here. Strategic Factory. I'm familiar with what they're doing over there. You need to talk to Lester and learn about what they're doing at Strategic Factory in terms of employee engagement, because it's really remarkable. And but I don't disagree with you about that. Does anybody want to comment on that? Employee engagement?
Just that, there's the old axiom that it's easier to keep a customer than find a new one. It's the same thing with employees. If you treat people, in my judgment, with dignity and respect and compensate them fairly and give them whatever career trajectory seems to make sense for them, then a lot of problems go away. At Jamison, again, it's a really old company, but we've got a wall that's got the name of everybody who's worked there 30 years. And it's a wall as big as where that dedicated sign is. I mean, covers the whole thing. We also found when times were bad, which they do happen occasionally, that there were layoffs in the factory, it's a union shop, and then in the office, everybody took a day a week off, except the managers who worked harder and took a big pay cut. So there was a sense of equity there. And when times are good, as they have been, then we pay the week's bonuses, and we do that, and pay dividends. We don't pay dividends without paying bonuses. And it's kind of amazing the attitude that exists in the company now, and fewer workers' comp claims and a lot of side benefits because we really work at having a great relationship and sense of equity and fairness with everyone.
We need to move on, okay? I'm sorry, Jeff, because I'm looking at the clock here. Thank you. Sarah.
Thanks, Mike. I'm curious for Doug and for Suzy. You both mentioned attracting a higher level of employee, engineers, designers. Are you having difficulty finding those employees in this region? And if you are, where are you going to recruit them? What resources are you using? And if you are going outside the area, are you finding issues with the perception of Baltimore as a region? That's kind of a lot of questions in one. But
it's an excellent series of questions. Good.
When we hire, we're always, when we're trying to top grade our team, we also believe in engagement. So we want to hire the best and keep the best. And if we have the best, then the best people, and give them the best culture and create the best kind of vigorous debate about what the right thing is to do, we're going to succeed. We're going to win. I feel really confident about that. The problem is so many jobs that we have are highly specialized, and there's not a deep community in this area of people that have experience doing the kinds of things that we want to do. I mean, even for basic things like, not basic things, but something you might not think of falling in that category, but marketing. So if we're looking for a marketing director, we're looking for someone with a certain cultural orientation. We're looking for someone that has experience in a certain type of industry. We're in regulated markets. We make components that are filter testing instruments that are of a certain sophistication. It helps if you're in one of those markets, a life sciences market, a pharmaceutical market, you have experience there. So as you start doing all these things, you're taking what was a big target and you're winnowing down the bullseye. And unfortunately, there's just not that many people that have that many experiences in the way that you need them in this market. We had as an old line company as well, we had sort of this long-standing cost aversion to relocating people. Oh my God, we can't do that. And that still exists in me. I'll look at Ron, who's runs one of our companies. He's probably sat across the table from me when I kind of went, oh God, another relo. But it does seem like so many of our positions, we just hired a CFO, relocation, marketing director, relocation. It's happening for our professional positions for, I don't know, half of our positions these days. So it's something that we have to do. Generally, we're able to find, the way we're able to we search using, national tools like LinkedIn and such. And we have to say now that we're open to relocation. We have a senior manufacturing engineering position open right now, or that's just about to go live. We are consciously going to be recruiting in the Midwest. I mean, that's where we're going to look first, because there's probably not a lot of point in searching in this area, frankly. When we do all that, people come in with their eyes open. They know what they're getting into typically. So we haven't had a ton of problem for ourselves, to be honest with you. Baltimore has a certain reputation, but usually the folks that are coming to us, have family in the area, or know that Howard County is a great place to be, or some are even interested in living in certain neighborhoods in Baltimore City. But it hasn't been a big deal for us to get people to overcome a certain Baltimore aversion. to be honest, in our experience. We don't do a ton of this. I mean, we do it, 2-3 times a year. But in terms of finding the talent, there's just not a deep bench for the things that we need in this area. So absolutely 100% we're looking elsewhere.
Sue?
And for us, it's been, it actually ties back to your comment as well, which is it starts with people. You can have all the great machinery and equipment and but if you don't have people, you're not going to have the great equipment and machine or whatever else. So, but in terms of that search, there's a balance of specialized skills and generalists. Generalists, we do find people locally largely through LinkedIn. Other specialists will recruit anywhere. We are very cognizant of market salaries. We do not want to be below market salaries. It's not an objective of ours. We want to make sure that people are happy doing their best. And for us, we found that we're not. There are large companies that are really great at training first employees out. We also found that we don't want to be people's parents. We're too small. We're too small to spend our time being people's parents. But one of the key spots for us is that 28-year-old who has been through a job or two, understands what a positive culture is like, and specifically wants to be here. And that means whether they're in Baltimore City coming out or whether they're in Baltimore County, they're happy. They want to understand that there's progression and that there's engagement. And so we also do a lot of having them travel. So we take 28-year-olds and we try to give them the world.
Yeah. Let me just tag on really quick, and then we've got somebody over here. MIT just this fall came out with a report. It's called The Future Work. And I'm going to share a little bit with you right now because it's so relevant to your question, Sarah. And essentially what they're indicating in their research, now this is for all businesses, not manufacturing, that there will be a skill shortage of careers that pay well. The skills will predominantly be technical skills. So, and they're advocating that we need, getting back to Anna, that post-secondary education learning will be required for these better careers and higher paid jobs in business in general. And we're going to be sharing more of that information, particularly with the Maryland legislature. So technology is driving the need for higher level technical skills in order for companies to be more competitive. We had somebody over here.
Hi, I'm Jordan Gershberg with Tolkol Food Products. My question is about growth. Each of you had a slightly different strategy, and the specific question is, how do you consider growth in your company as it relates to consolidation versus diversity, and whether or not to grow within your core competency or outside of your core competencies?
That'll be the topic of our next forum. Can we answer that quickly, because I'm looking at the clock and I want to be sensitive to our 11:30 end time. Did anybody want to take a shot at that quickly?
Well, we have chosen to grow in good times and bad and always invest in that, and grow organically, except for when we bought the air door company. It was in Montana, and have steadfastly resisted getting outside money and rather just use internal money and grow in our niche. And then with the high-speed roll-up door market, we're able to go now more into the general industrial market. But prior to that, we want to be one-stop shopping in the food market for doors.
Okay. Doug?
It's a multi-layered question, obviously, with 3 companies for us. But we've got, in some cases, we're doubling down on the markets that we're in, where we're really trying to expand our share within that market. And in others, we're looking for adjacencies. And in others, we're looking to kind of tack on a new product category to the same customer, for example. So it's a mixed bag and very specific to our business and the climate and the business conditions within each one of those segments.
And ours is a yes to his. It's, we'll grow within existing, we'll grow international, and we'll grow with new products and new systems, actually, that allow people to do something faster. But I think it would make a good conference as a follow-up.
Okay. I'm sorry, I can't take any more questions because of where we are in time, and I want to inject something into the program. But let's give the panel an applause first. And you can take your seats if you want. I want to talk just slightly. We've heard the future manufacturing from the business perspective. Let me talk about the future RMI for a second. okay? 30 years we've been out there providing services. RMI has been very blessed in that we've had these amazing stars, you know, become part of our constellation over the years. I'm looking in the room, and I know Chris Plater is probably the person that I've known longest and working with her over the years. And she was with Commerce or Dollar then, now or Deed, and now she's working with us. But probably one of the really bright stars that came into my life and to the life of RMI that I'm going to tell you is why we are the organization that we are today. And that's my good friend and my vice president, Peter Gourlay, who's right in the back here. Now, if you hadn't seen Peter in a while, you know he's got a new hairdo, okay? So let me explain. Peter, in October, found probably one of the biggest challenges of his life, and it was cancer. But characteristically, Peter Gourlay, you know, looked at his situation with great positive and willingness to say, I'm going to take care of this, we're going to get it done. And so, Peter, I know from talking to so many people, we're all with you, friend. We're all with you. Don't worry about your hair. It's your smile that we love, and it's your kindness and the fact that you touch people in such a positive way. I know for me personally, it's allowed me to say, yeah, let's keep RMI going. You're going to get better. You're going to take over the leadership, and we're going to really do wonders along with groups like Mike Kelleher and Maryland MEP to make Maryland manufacturing matter. So, Peter, thank you for being here today. You know, obviously, he's doing chemo right now. Hope you don't mind, I'm sure. And, you know, some days are worse than others. But he's got his Michael Jackson gloves on, not because he's going to dance, but because he can't afford to be exposed to any bad germs. So, Peter, one more. Now, I know Stacy Smith was the leader of CAMI, the cybersecurity, and we're fortunate. Like I said, she came on board to work with RMI. She's got her own business now, but she's given us a lot of time. And we have an event coming up that I wanted Stacy to talk to you about because I really, really would ask that you consider coming out on this 2/20/2020 downtown for this first of its kind event. And if nothing else, it's to come out, have a drink, have fun, and meet all the people that we're going to have in the room. So, Stacy, you want to tell them about what we're doing?
Thanks, Mike. So talking about the image of manufacturing, one of the things we're trying to do with this event, unique event, is it's called a fashion show, but as I've told some of you here today, in fact, TAI Engineers is a sponsor, and he said, I looked at our marketing crew and said, why are we sponsoring a fashion show? And I said, it's a completely different kind of fashion show. So it's on February 20th at the Visionary Arts Museum from 5 to 8 p.m., and we are featuring Maryland wearables on this runway. So we do have Lion Brothers participating. We're not sure yet if it'll be a Girl Scout wearing some of the Girl Scout badges that they manufacture, maybe a NFL player wearing some of the NFL gear. But we've also got bulletproof vests. We've got Hamaltro, who will have a female.
Excuse me.
Yeah.
There's a rumor that somebody's trying to get Lamar Jackson to show, but we'll find out. Chris Plater called me. Excuse me. Chris gave me that. I said, Chris, if we get Lamar, I'm canceling the 2020 and getting the Civic Center.
So we've got bulletproof vests. We've got Hamaltro, who makes like the Jaws of Life. They will have a female firefighter walking down the runway carrying one of their rescue tools. We've got Seio Baltimore, which is a custom watch manufacturer in Baltimore. We have very few traditional things you would see on a runway. So I think it'll be very different kind of fashion show, a lot of high energy. We've got a great DJ, and we just invite you to come out and see what cool things are being manufactured right here in Maryland. It's all new to me, and so some of these companies I'm saying, wow, I had no idea this was made right here. Dunlop Boots will be there, of course, a staple here in Maryland that we all know and love.
Ever since we met Mary Steinbrenner Dunlop, we said, let's do a show with the boots and the runway. So we're looking forward to that. Also, it's 45 minutes with the fashion show. The rest of the evening is networking. Lester Miller will be there, so it's worth coming just to hang out with him.
And just so you know, early bird rates expire next Friday, and we do have sponsorship opportunities if anybody's interested in sponsoring. Get your name in front of about 300 attendees there.
Yeah, it's going to be fun. Rebecca Haltberger will try to get her to show. It's at her place. It's a great venue, so come on out and join us and have fun. thank you all so much. Peter, again, my friend, thank you for being here. We love you. Take care. See y'all later.